In today's video, we're going to talk about the monetary policies that we use in the United States with the Federal Reserve and compare that against what's used in the Eurozone. Some of this content gets very, very complicated, and it's not my goal here to make it as complicated as possible to make you, experts at the PhD level or anything, but rather it's just to give you exposure. Now, when we're talking about policies within the United States, I hope you've already had some exposure to those ideas, but I doubt you've seen anything of what I'm going to discuss here with the Eurozone. So let's jump in. First of all, it's important that you understand the system that most of you are a part of, which is as a United States citizen, you're accustomed to dealing with the United States financial system, and at the top of that financial system is the Federal Reserve. The Federal Reserve is the system or the central bank of the United States. They have massive amounts of power in the United States to affect policy, and they also have a lot of autonomy. When it comes to fiscal policies, changing governmental laws, those types of things have to go through the regular checks and balances with the U.S. Congress, Supreme Court, and other entities like that, right? Through the different executive, judicial, and legislative branches. But when it comes to the Federal Reserve, they are separate and independent of the federal government. In fact, they are considered not technically a part of the federal government. And so if we enter a sudden period of economic crises like COVID or the 2008 financial crisis, the Fed can act a lot quicker and a lot stronger than the federal government because it does not have to answer to the federal government. So let's jump into the Federal Reserve here a little bit. There's really no way to overstate how important the Federal Reserve System is on a global scale. The Federal Reserve is considered one of the big four central banks in the world, along with the central bank in the Eurozone, Japan, and Australia. Just because of how economically important they are, they dictate effectively how monetary policy works throughout the world. But no country is important as the United States when it comes to monetary policy. Um, while we have about 340 million citizens in the US using it on its own, there are various countries such as those listed there, Ecuador, El Salvador, Zimbabwe, that use the United States currency as their primary currency. Part of the reason for that is the United States system works really well. So if you're a country like Zimbabwe that's had major problems with hyperinflation, it's really attractive to just use a different currency. And they've chosen the United States currency because of its economic power. There's also countries that in certain areas or throughout the country consider the US dollar to be a secondary currency. Even a country like Canada, around the border and in touristy areas, the United States dollar is accepted readily, which again is pretty unique. About 58% of foreign reserve holdings, so that would be money held outside of the United States by usually federal governments, is held in US dollars due to its relative stability. And in fact, nearly half of all physical US currency is not in the United States. It's held in other countries. So again, it just goes to show that the United States dollar is really a global currency. And if that's not illustrated enough, about 90% of all foreign exchange trades involve the US dollars. Now, to be clear there, you need two currencies to do foreign exchange. So that doesn't mean that 90% of all money exchange is US dollars. It's 90% of all exchanges involve US dollars. If you look at currency exchange, the vast majority of those currency exchanges throughout the world are US dollars against either Japanese yen or the euro, British pounds, Australian dollars. That makes up the vast majority of exchanges that happen in the world. Hope you know a little bit about this already, but the Federal Reserve has 7 members in its Board of Governors. These Board of Governors are appointed by the U.S. President, and they have to be confirmed by, I think it's Congress. Interestingly, in those 7 people that you see over there that are currently members of the Board of Governors, Lisa Cook, the one third from the bottom, she is, believe it or not, a native of Milledgeville. Both of her parents were pretty important figures here in Milledgeville. If I'm not mistaken, I believe her mom actually taught at Georgia College. Her election was actually a little bit, her appointedness was actually considered a bit controversial because she didn't maybe have quite as much training in macroeconomics or finance as some of the other members Nonetheless, she's definitely a lot smarter than I am and a pretty important economist. Most of these members of the Board of Governors have extensive training in econ and finance. They've had a long career working in either economic research or working directly for central banks. And you should hopefully, at the very least, know that name at the top, Jerome or Jay Powell. There's not many more people that are more powerful than him. Being the chair of the Federal Reserve Board is incredibly powerful because, as I said before, since you're not part of the federal government, you have a lot more autonomy to make changes, and they don't have to wait for things to be ratified. They don't have to wait for laws to go through. Within 5 minutes, the Federal Reserve can react to something happening in the economy and move hundreds of billions of dollars around. It's really a massive enterprise. You can see on the right over there, by the way, that is the 13 districts of the Federal Reserve System. The logic of that is that every district has its own set of problems and economic concerns. So what's going on in New York City versus what's going on in Central Georgia is really quite different. So each of those districts are effectively designed to keep an eye on what's happening in their local region. And the Atlanta Fed is the headquarters of our region. If you ever get a chance, you can go up and visit the Atlanta Fed, go to a pretty crappy museum, and see what it's all about. Hey, it's free, so I shouldn't complain. The Fed is often identified as having a dual mandate, which means there are two things that the Fed is supposed to do. These are the primary objectives of the Fed. Now, these dual mandates were made a long time ago, and the Fed is a lot more powerful now than it was when this dual mandate was instituted. But nonetheless, they're still relevant today. One of those important factors is that it needs to maintain maximum employment. The Federal Reserve is tasked with trying to keep unemployment at its lowest reasonable level, which we call the natural unemployment rate. Now, you don't want unemployment to be zero. All right, if nobody's unemployed, that's actually really bad for the economy. And that wouldn't really happen unless there's something weird going on. Think about that. If everyone's employed, it kind of doesn't really give people an incentive to work. But if a few people are unemployed, or a small percent, it makes you a little bit fearful that you could lose your job and join that rank, so you might work a little bit harder. But furthermore, you need job turnover because some businesses should be failing. If a business is poorly run or is creating goods or services that are now outdated, failure is good so that those resources can be spent on more important things. So we want an unemployment rate that we think is probably around 4 or 5%. That's the natural unemployment rate. And so the Fed is aiming for that target. And that means that if the unemployment rate gets up to, say, 6 or 7%, the Fed is going to try to do things to speed up the economy to get more people hired. And also it means if the unemployment rate's down at, say, 2.5%, 3%, the Fed might do things to slow down the economy. And that often draws the ire of policymakers because when you're the US president, for example, you want the economy to be as strong as possible to perhaps become reelected. But the Fed is not supposed to be thinking about things like that. It's not supposed to be political in nature. It's supposed to do what's best for the long-term health of the economy. The other thing the Fed is tasked with doing is maintaining price stability, which means both low and stable inflation. Now, I think most people understand the low inflation part of that. All right, we understand we don't want prices to be rising at 50% per year. That's just bad for everyone. We also don't want deflation. We don't want prices to go down because when prices go down, that gives you an incentive to wait to buy things. For example, if I know that prices are dropping 3% every year and I need to buy a new car, it behooves me to wait to buy that new car and wait for those prices to go down. So you don't want deflation and you don't want really high inflation. You want it low, okay? 2% is often considered the goal. 2% inflation is nice because prices are rising, but very slowly. So you've got a little buffer there. 2% is 2 percentage points away from deflation, but it's not so high that you feel compelled to try to get rid of currency like you do in hyperinflation standpoints. But it's not just low inflation. Stable inflation is important too. You need to be able to predict what prices are going to look like in the future. So it's important that inflation is known by individuals. So for example, if I'm making a business deal and I say I'm going to buy $5 million worth of oil in 6 months, I need to know what $5 million worth of oil is going to look like in the future. I need to know what $5 million is going to be worth. And as long as inflation is stable, 2 or 3%, 5% even, I can predict what those prices are going to look like. So it's not just about inflation being low, it's also about it not jumping around a lot. And also, in addition to that, there's a third objective that is not put into that quote unquote dual mandate, but it's pretty clear that the Fed's involved with this too, and that is to maintain stable and moderate interest rates. Now, all of these goals work hand in hand, and that's the complicated thing about this. When you increase prices, inflation rates tend to go down. Uh, Likewise, when you decrease interest rates, inflation rates tend to go up. So there's a connectiveness among these, but nonetheless, the Fed doesn't want interest rates to be extremely high, doesn't want them to be 20%. Generally doesn't want interest rates to be incredibly low because then you lose some of the power to lower them if there's a bad economy. And it also wants interest rates to be stable. If I'm making economic deals, I don't want to be thinking in the back of my head, well, what happens if interest rates go up? What happens if they go down? I want to be able to assume that interest rates are going to be pretty stable because that's going to encourage me to engage in economic behavior. Now let's compare that a little bit to the European Central Bank. Now I know a lot about the Fed. I would consider myself, quasi-expert on that. European Central Bank, I'm learning as I go, to be totally honest with you. But I'd like for you to have a passing knowledge, just like I would like to have a passing knowledge for this content. The European Central Bank is also a member of those big four. It's obviously incredibly important. There are 20 member nations, so 20 nations in the Eurozone or in Europe that are members of the Eurozone. That means that they explicitly use the euro as their primary currency. It's also relatively easy to use the euro in some other countries when you're traveling around. So you can kind of think of the euro as being almost like a Europe-wide currency. Now, if you go down to Switzerland, they don't use the euro, but even there'll be some places that will accept it, or it's very easy to exchange for Swiss currency if you need to. 20% of foreign reserve holdings are held in euros, so yeah, take that with what we learned about the U.S. a bit ago, and you'll see that almost 3/4 of world Federal Reserve holdings are held either in U.S. dollars or in the euro, and 30% of all foreign exchange involves the euro. So it's not as important as the U.S. dollars from a worldwide standpoint, but it's an obvious, clear number 2 in the ranking. Similar to the Federal Reserve, there's a group kind of like the Board of Governors. They're called the Governing Council. They're appointed by the European Council, which is essentially just the head of various European Eurozone nations. And you can see listed there the current members of that executive board. Not a whole lot to talk about there, but I want you to have some understanding of how decisions are made. And with the United States and the Federal Reserve, a lot of that comes down from the U.S. president and works its way down to the Fed. With the Eurozone, we're talking all of these members of the European Council electing or appointing these individuals. And both in the U.S. and in the Eurozone, they serve very long terms, with the idea being that if you serve long terms, you can be more long-term oriented with your decision making, and also you might not be swayed so much by politicians. So if I'm a member of the Board of Governors in the Fed, for example, they serve very long term. I think it's 14 years. I don't really have to worry about some politician not liking me, right? Because I've got significant job security. 14 years is a long time. Long terms also for members of the Governing Council as well. The key objective of the European Central Bank is primarily focused on inflation, maintaining inflation that's around 2% and is relatively stable. It's pretty much the same goal that we have for the Federal Reserve, and indeed, a lot of the policies that the European Central Bank has adopted are effectively just mirroring what we've done in the United States. But with the European Central Bank, there's not as much of a focus on employment. And let's think about why that would be the case. The Federal Reserve has one country that it's responsible for, whereas the European Central Bank has 20, right? With 20 countries, it's very possible that one country will have relatively high unemployment while another country is doing very well. And it's hard for the European Central Bank to think about all of these countries in unison. It's just really not feasible. So the European Central Bank is focused primarily on inflation. Even interest rates are tough to consider at the same time. Interest rates in one country can be quite different than they are in another country. The spread among these interest rates in the Eurozone is actually quite a source of contention and a problem area for the European Central Bank. But as the European Central Bank has made it abundantly clear, its primary objective is inflation, not interest rates, not unemployment. For both the Federal Reserve and the European Central Bank, these members of the decision-making bodies look really similar. You're talking people generally with PhDs, long either academic or central bank careers. Some of them have worked in government, but these are all very impressive individuals. Uh, both central banks, their decision-making bodies are made with independence, meaning they're supposed to act beyond the scope of what is politically intended. So they're not politicians, they're not policymakers, they're not even elected individuals. You and I, we don't directly elect our members of the Board of Governors. Regarding who is chosen, as I said earlier, in the United States, the president selects members of the Federal Reserve Board of Governors. For the European Central Bank, it's the members of the European Council. The length of term is very, very long, and I want to again emphasize why that's the case. Long length of term means that these individuals can be focused on the long-term health of the economy. They don't have to worry about getting reelected. They don't have to worry about job security. They can be focused on simply what is best for the economy and the health of their nations. Now it's kind of the tricky part. If you've never seen this before, this can get a little bit difficult. Let's talk about monetary policy within the Federal Reserve. Monetary policy is really, really important. And I think for the layperson, the non-econ, non-finance student, they think that the federal government is the end-all be-all when it comes to policies. But the Federal Reserve is very, very important. And from an economic standpoint, if we're thinking about stabilizing the economy, I would say the Federal Reserve is more important than the federal government. Now, let's be specific here what we're talking about. The Federal Reserve is engaged in monetary policy. Fiscal policy is adjusting interest rates. I'm sorry, fiscal policy is adjusting tax rates and government spending, things like that. Whereas monetary policy is using price levels, adjusting how much money exists, adjusting interest rates, with the goal of trying to either speed up or slow down the economy or do one of those other things we talked about, like trying to get interest rates stable, trying to get inflation to decrease or to increase. These are all important portions of monetary policy. Generally, the goal, if we're trying to increase economic activity, like if the government or if the economy is going through a recession, the typical prescription of that would be to increase the money supply or cut interest rates. And those two things go hand in hand. So it's really hard to do one without the other. When the Federal Reserve increases the money supply, interest rates will go down. And likewise, if the Federal Reserve reduces interest rates, the money supply will go up. Those two things move in unison. And that will affect lots of other things in the economy, right? Increasing money supply, cutting interest rates, that usually speeds up the economy because when there's more money to spend. Likewise, when interest rates are lower, people are more likely to borrow money, and that spurs economic growth. So if the goal is to increase economic activity, we know how to do that. But sometimes the goal is to maybe decrease economic activity or to reduce inflation. So in the United States, 2023, 2024, a major goal of the Federal Reserve was try to kind of cut back inflation rates that had gotten a bit out of hand. They had to go the other direction with that. If you want to reduce inflation, you have to decrease the money supply or raise rates. And if you look during that period, interest rates increased substantially as the Fed tried to slow down the amount of spending people were doing to cut down on prices. Now, how do they do that? How does the Fed actually go in and manipulate prices and interest rates in the economy? Well, they've got four primary tools, and we'll talk about which of these are most important, but we'll start with what I think is probably the easiest, which is open market purchases. It's a really simple idea. Now, before I even go into this, let me just be very clear here. I think a lot of people assume that if the Fed wants to increase the money supply, it just prints money. First of all, let's recognize that most money is not printed. Most money does not physically exist. Think about how much money you have. Just right now, count up the amount of money you have. Probably the things you would be included in that would be like checking accounts, savings accounts, hell, maybe even stocks. But those things don't physically exist. The money you have in your checking account, that money's been loaned out. The bank doesn't really have it. But yet you still consider it money, and indeed it is money, even though it doesn't physically exist. So most forms of money don't exist. So does the Fed print money to increase the money supply? Not really. It can, but the Fed's ways of increasing the money supply are a lot more sophisticated than that. And this first one really is the one that's closest to just purely printing money. It's open market operations. Open market operations is buying or selling stuff to change the money supply. Purchases increase the money supply. Sales decrease the money supply. So, for example, if the economy is struggling a bit and the Fed wants to increase the money supply, it can print money or create money digitally. That's pretty easy to do. The Federal Reserve can just create money whenever it wants. So what it can do is it could say, Bank of America, we're going to send you $20 million in exchange for some government securities. That $20 million gets moved over to Bank of America digitally. It doesn't physically exist. But it increases the money supply because digital money is just as real as physical money is. The Fed can really buy anything, but traditionally it has been government bonds. So to increase the money supply, the Fed will create new money out of thin air, buy assets, usually government securities with that money, and now that's new money out there in society. Or if it wants to decrease the money supply, it can sell government bonds back into the market and then destroy that money, which might be literally pressing a backspace or delete key on a keyboard. Okay. And once you start understanding that money doesn't have to be physical, this type of behavior is really quite simple. Just by adding 1 and a bunch of zeros behind it and then sending that money to a bank, the Fed has increased the money supply without printing anything. The second policy that the Fed can engage in is adjusting the required reserve rate. The required reserve rate is the percent of deposits that banks are required to hold. Historically in the United States, that rate has been 10% for checking accounts. So what that means is if you put $100 into a checking account, the bank is required to hold $10 of that money. Now, to be honest, they don't have to hold $10 of your money. They just have to hold 10% of all of the money they have in checking accounts. So if that bank has $10 billion in checking accounts deposited, it has to hold $1 billion in reserves. And it's got some leeway about where it can hold that money. If the Fed wants to increase the money supply, it can decrease the required reserve rate. To understand why this is important, you first need to realize that banks create money. How does that work? Well, if I take my money to the bank and then the bank loans it out, it's kind of doubled the money supply. All right. If I put $1,000 into a bank and then the bank loans it out, I still feel like I have that $1,000. I can still spend it, right? I can still access that money by using my debit card, or I can withdraw that money. But at the same time, someone else is using that money too. So that money can get used multiple times. In fact, it can get used more than twice. It can get put back in a bank, loaned out, back in a bank, loaned out over and over again, meaning that $1 could turn into a lot of actual money. So when the Fed lowers the required reserve rate, allowing banks to make more loans, that increases the money supply. When the Fed raises the required reserve rate, that decreases the money supply. That being said, this policy is actually not something the Fed can do now. In 2020, as part of the relief efforts to try to make the economy not struggle too much during COVID, the Fed did something that was really unheard of, and it dropped the required reserve rate from 10% to nothing. It got rid of the required reserve rate. So now banks aren't required to hold any money. Now they still do, because if I go into the bank and ask for money and they don't have any money, I'm going to freak out and close my account. So banks have a financial obligation to keep some money there because it allows their customers to feel comfortable using that bank. But the banks aren't required to hold any money in the future. So I guess what we could say is right now, this is a policy that would only work for decreasing the money supply, because we can only increase the required reserve rate in the U.S. right now. Can't go below 0%. A third policy, and this is starting to get a little bit complicated, so I'm going to send you some resources that will help you along the way with this. A third policy that the Fed has is it can reduce what's called the discount rate below the federal funds rate. Before we can even explain why this works, let's make sure we understand the terminology here. The discount rate is the interest rate that banks are charged when they borrow from the Fed. So if I work for a bank, if I'm like an executive at a bank and I need money, one option is to borrow from the Fed. And if a bank borrows from the Fed, they're borrowing new money. So that increases the money supply. The other option a bank has is if a bank needs to borrow, it can borrow from other banks. If a bank borrows from other banks, it does so on the federal funds market, and the interest rate it is charged is the federal funds rate. That doesn't increase the money supply. If I'm a bank and I borrow from another bank, that money already existed. That doesn't directly change the money supply. Now, there's a connection between the discount rate and the federal funds rate. The federal funds rate is pretty much always below the discount rate. Think about why, all right? If I'm a bank and I need money, if the Fed is charging 5%, the only way another bank is going to be able to loan to me is if they charge me less than that. So the discount rate becomes a ceiling on that federal funds rate. The federal funds rate very rarely goes above the discount rate. But if the Fed wants to increase the money supply really quickly, just quickly increase the money supply, it won't be a long-lasting thing. What it can do, though, is it can drop the discount rate below the federal funds rate. So if the discount rate is 5%, the federal funds rate is 4%, the Fed can drop that discount rate down to maybe 3%, and now for a short period of time, banks will borrow from the Fed, and they'll be borrowing new money. Now, I say it's a short period of time because that federal funds rate is also going to drop too. But for that short period of time, banks will borrow from the Fed, and that will be new money, increasing the money supply. That's the third policy the Fed has. It's not something it does real often, and it's not incredibly powerful because it's so temporary. Those first three policies we talked about are obviously important, but the fourth one is the most important, and it is the Fed's primary tool, federal funds rate targeting. The federal funds rate is, again, the interest rate banks charge one another, and billions of dollars are exchanged from banks to banks in the United States every single day. The scale here is just unbelievably massive. Banks are borrowing and loaning to each other all the time. And to think about why, just think about incentives banks face. The way banks profit is by making loans. So if I'm a bank and I want to increase my profits, I need to figure out a way to loan more money. And if I don't find a way to loan more money to customers, I've got to figure out some other way to loan that money out, and that might be to another bank. Some banks really need money right now. Some banks have extra money right now. It is mutually beneficial for the bank that has extra money to loan it to the bank that needs money so that they can do more loans. So money is moving very quickly from banks to banks. These loans usually are very, very quick. We're talking about, hours or sometimes even minutes. Money is loaned and then paid back. But the scale is so big, billions of dollars, that the interest rate does play a major role. And that interest rate the banks charge each other is, again, the federal funds rate. The federal funds rate really affects the way banks behave because usually if the federal funds rate is very high, banks will be scared. And if federal funds rates are very low, banks will not be so scared. They can be more aggressive. So as it says there on the screen, when the federal funds rate is lowered, banks get more aggressive with their reserves, which means they loan more money. Here's the reason why, okay? If I'm a bank and I'm thinking about loaning money, always in the back of my head is, well, what if I run out of money I'm going to have to borrow? Now, if I know that the federal funds rate is really low, it's not a big deal if I have to borrow. So I can loan out all of my money and not really worry if I have to borrow because the interest rates are low. Effectively, the punishment for running out of money is tiny when the federal funds rate is low. On the other hand, if the federal funds rate is 15%, really high, I do not want to run out of money because I do not want to have to borrow. So I'm going to hold extra money and be extra cautious. So when the federal funds rate is low, banks can be aggressive. They make more loans. That increases the money supply. When the federal funds rate is really high, banks get cautious. They tend to hold extra money, and that decreases the money supply. Now, maybe what's most complicated about all of these is what I'm about to tell you now, and that is that the federal funds rate is not determined by the Fed. It is determined by the banks themselves. And the only way the Fed can adjust the federal funds rate is to manipulate it through one of the other three policies that we've already talked about. So, for example, if the Fed wants to lower the federal funds rate, it doesn't have the direct ability to do that. It doesn't control the federal funds rate. But what it might do is engage in open market purchases. If the Fed spends money, increases the money supply by buying things, banks now have more money. They don't need to borrow as badly, and that will push the federal funds rate down, which makes banks more aggressive. So there's kind of this two-stage effect when it comes to monetary policy. The Fed does something that increases the money supply. That increases the money supply. That causes the federal funds rate to go down, and that decreases that money supply a second time. Okay? Now, you might be wondering why the federal funds rate is the key policy, and it's really because the federal funds rate has to be, as we'll see here in just a second. And the fifth and final policy that I'll mention here is one that doesn't have a clear impact on the money supply, but it is so important for the Fed because the federal funds rate is so important. And that is the interest on reserve bank holdings held at the Fed. If I'm the Fed, if I'm a bank, I can take any money that I have, and if I don't want to lend it anywhere, if I don't want to lend it to the other banks or to individuals for mortgages or anything like that, I can actually store my money at the Fed. And if I store my money at the Fed, I get interest on that, and that's called the IORB, the interest on reserve balances held at the Fed. This interest rate is really important because it affects the federal funds rate. If I'm a bank and I know I can hold my money for 4.75%, I'm not going to be willing to lend money to another bank at a rate that's lower than that. So the interest on reserve balances becomes a floor for the federal funds rate. So what this really ends up meaning is that there is both a ceiling and a floor for the federal funds rate. The interest rate that banks charge each other flows not freely up and down indefinitely. It only flows to a ceiling and a floor. Here's what I mean by that. The interest on reserve balances, that's the rate that banks can lend their money to the Fed or hold their money at the Fed. That becomes the floor. So the federal funds rate's never going to go below that level. If banks need to borrow, they can borrow money from the Fed, and they would never be willing to pay more than what the Fed is charging. That becomes a ceiling on the federal funds rate. So the federal funds rate can only flow between those two rates. You can see that very clearly here in this graph. The federal funds rate is technically not determined by the Fed, but really for all intents and purposes it is, because they have a ceiling and a floor. So by moving the ceiling and the floor, they can affect interest rates. And that's what you see here. That top line is the discount rate. The bottom line is the interest on reserve balances, and that little dotted line in the middle, that's what's actually happening with the federal funds rate. So the interest on reserve balances, the discount rate, even though they're not really that important for changing the money supply directly, they are indirectly extremely important because they're used to target the federal funds rate very precisely. The federal funds rate, you can feel it affect your everyday life if you know where to look. The federal funds rate affects all interest rates in the economy, be it mortgages, savings accounts, whatever. And let's think about why that's the case, okay? Let's say that I'm thinking about going in and getting a mortgage. So I'm going to go to my bank and ask them what rates are on a 10-year or 30-year mortgage, okay? For banks, you can kind of think about the federal funds market as an opportunity cost of sorts. If I work for a bank, I can always lend money into the federal funds market. So if the federal funds rate is 4.25%, that means I can loan money to another bank pretty much risk-free at 4.25% interest. Now, if I'm going to loan money to you for a mortgage, I'm always going to charge you more than that because you're risky, right? So the federal funds rate becomes a floor on mortgages and other forms of borrowing that individuals do. And we know forms of borrowing are really important, right? Borrowing money for mortgages, to buy a car, to start a business, things like that are really important for the economy. So the Fed having this way to control interest rates in the economy is a major way that they have a huge influence on the economy. And that power dynamic isn't just on the side of what if banks are trying to lend money, it also applies to banks that need to borrow. Now, this is kind of a weird way to think about it, but when a bank borrows from you, that could be in a situation like when you open a checking account, right? When you open a checking or a savings account, the bank is borrowing from you. So just like we said before, the federal funds rate is kind of like an opportunity cost. That's the same deal here. If I'm a bank that needs to borrow, I can borrow as much as I need to on the federal funds market. So if the federal funds rate is 4.25%, I'm a bank, I can borrow as much as I want at 4.25%. That means that I'm not going to give you more than 4.25% on your savings account. So the federal funds rate becomes a ceiling for individuals that are trying to save money. So the federal funds rate is a floor for citizen borrowing and is a ceiling for citizen saving. So even though the Federal Reserve doesn't make laws about what savings rate should be or mortgage rate should be, they have a very clear influence on what these rates actually end up being in the economy. And that's how it affects our day-to-day lives. And just as an example of that, you can kind of see this here. That I'm colorblind, but that bluish looking line there, that's the interest rates on mortgages. And that line down there below it, is the federal funds target for the Federal Reserve. And you can see that the mortgage rates are always above the federal funds rate. And also you can see that they move somewhat together. It's not perfect because there's multiple things that affect mortgage rates, but you can see there that there's definitely a correlation between the two. When the Fed increases rates for the economy, mortgage rates usually go that direction as well. So if we think about what the Fed was doing back in 2023 or so, the Fed was really worried about inflation, so it increased the federal funds rate, and mortgage rates went along with it. During 2020, the Fed was very concerned about the economy getting too weak, so it tried to do things to stimulate the economy, such as lowering interest rates. So you can see mortgage rates dropping in 2020 as the Fed tries to stimulate the economy. And you can see again interest rates going up as the Fed tried to fight inflation and slow the economy in around 2022, 2023. So if we think to kind of summarize here what the Fed might do, it's one thing to think about the economy when things are strong. People don't really care about the economy as much when things are good. But when the economy is bad, people really seem to focus on it. So we might wonder, what is the Fed going to do during periods of economic turmoil or a recession? And this is what we would expect. One, they would do open market purchases. That means the Fed would create money and spend it. And by spending that money, putting it into the economy, it increases the money supply. The Fed can undo that in the future if it wants by buying those assets back. Second thing you can do is lower the required reserve rate, drop that required reserve rate down so the banks can loan out more money. The third would be to drop the discount rate below the federal funds rate. That would cause banks to borrow from the Fed, and they'd be borrowing new money. And the fourth one there, the fourth really important one, is to target a low federal funds rate. When the federal funds rate is lower, banks are more aggressive. They're more likely to make loans. And remember, the way you target a lower federal funds rate is by engaging in the other policy tools of the Fed. That's just kind of a review. And I want to reiterate, this can get really complicated. Some of you are seeing this for the second or third time. Some of you may be seeing it for the very first time. I hope not, but some of you may be seeing it. All of this may be new. If that's the case, I've got some other resources I'm going to send you that are a little bit more thorough just to make sure you're caught up to speed. So by going through the Federal Reserve policies, what I'm hoping is you get a perspective of what's different about what we do in the United States versus what's done in the Eurozone. And again, I'm not trying to make you an expert on this. Really, I think if you're a U.S. citizen and you're studying econ or finance, you should know about the Federal Reserve. You should know a lot about the Federal Reserve, but you should also have some passing knowledge of what's going on with the world's second most important currency, which of course is the euro. So let's talk quickly here about the European Central Bank and the types of policies that they use. And it appears that the first major policy that the European Central Bank uses is these what are sometimes called reverse transactions. Now, keep in mind, I'm not an expert here. I have the critical thinking skills to explain how this stuff works, but it's not something I was trained on in grad school or anything. Reverse transactions, though, are kind of like open market purchases, but they are directly connected both to interest rates and how much money is directly put into the economy, okay? Now, there's a couple of different durations that the European Central Bank is most engaged in. One of those is these pretty short-term loans called main refinancing operations, or MROs. These are pretty regular loans, pretty much happening all the time, where the European Central Bank buys or loans money to these banks. I don't really know which term to use there, whether buy or loan. I've seen it written both ways. But effectively what the European Central Bank does is it loans money to these banks for a week. These are secured loans, meaning that there is collateral for those loans. And then the bank has a week to pay that money back. Now, if they fail to pay that money back, the European Central Bank gets to keep its assets that it put up as collateral. So it's what's called secured debt, which means there's collateral connected to it. And this is sold via auction, meaning the European Central Bank will say, we have X amount of money available, and then these member banks can decide to bid on that money. What's in it for the banks is it allows them to get liquidity if they need it, so if they just need cash, or also if they have some loans that they know will be very, very profitable, they can engage in this purchase of these funds, which allows them to have more money in the short term, and then they can eventually pay the European Central Bank back. What's nice about this from the European Central Bank is by doing it weekly, is it gives them a real fine-tooth comb for changing interest rates in the economy. If they want interest rates to go down, they can do more of these loans. If they want interest rates to go up, they can kind of cut off these banks by doing fewer of these types of loans. So those MROs, those are 1 week loans. There's also longer form versions of that, such as these LTROs, longer term refinancing operations, which are usually about 3 months long. Those are two really primary tools for the European Central Bank, but they also do various other forms of policies that are similar to this. And during times of real extreme economic turmoil, they get far more engaged with these types of behaviors. If we want to think about how these compare to Federal Reserve policies, again, it's a little bit confusing because they call these transactions open market purchases, but they're really more like loans than they are purchases. So they're almost a hybrid. The central bank is creating new money and then loaning it to these banks, but the banks aren't obligated to borrow it, and also they can change the interest rates by offering more, offering less. It's really a pretty sophisticated thing. But again, I think what's really important to understand is that they're doing this all the time, and as such, they're able to have a pretty direct role on interest rates and inflation. So to kind of think of this as two different policies, let's break it out here. When the Central Bank of Europe engages in reverse transactions, they are, one, directly increasing the money supply. So when the central bank loans money out to a bank, that is new money entering the economy. That changes the money supply in and of itself. But as a secondary effect, it also changes interest rates, which in turn can result in changes in money supply as well. Pretty similar to what we learned about with the Fed here. If I'm a bank and I need to borrow money, I could, one, borrow from citizens by luring people to come and open up checking accounts or savings accounts or whatever. Or I could, two, borrow money from the European Central Bank. So if I know the European Central Bank is charging 2%, I'm not going to give my citizens more than 2% when they come into my bank. So by doing these MROs, the European Central Bank has a really strong control on interest rates. Namely, it's created a ceiling on short-term interest rates in the economy. The European Central Bank has also created a floor of sorts for this type of policy. If I'm a bank and I have extra money, I'm also allowed to loan my money to the European Central Bank or hold my money at the European Central Bank. This creates a floor on short-term interest rates, and you should be able to compare this to what's going on in the Federal Reserve because this is really quite similar to what the Fed does with federal funds policies. So just like we saw that federal funds sandwich a bit ago, there's a short-term interest rate sandwich in the European Central Bank system. The MROs create a ceiling on interest rates, and the deposit facility creates a floor on interest rates. And in doing so, the European Central Bank has a way to control interest rates, and we know that interest rates are really important for the economy. When interest rates go down, money supply goes up. When interest rates go up, money supply goes down. So by raising the floor, lowering the ceiling, they have control over interest rates and in turn an indirect control over how much money is in the economy. The European Central Bank also has a required reserve rate very similar to what we have in the United States. It also doesn't change it very much though. It's been at 1% since 2012, so that means that out of every $100 that is held at banks that are members of the European Central Banking System, 1% of that must be held in reserves. Just like the Federal Reserve will sometimes get really extreme with its actions, so too will the European Central Bank. It also has these asset purchase programs. This is just when the European Central Bank will go out and buy stuff. This is akin to open market purchases with the Federal Reserve. In 2020, the European Central Bank, just like the Federal Reserve, is very concerned about the economy, and so it spent more than $1 trillion by buying various assets. Think mainly bonds, government bonds, things like that. But it spent over $1 trillion. Created new money, spent that money, and it's all about getting that money out there in society. With more money, that should help create economic growth in the short term. So when things look bad in the short run, the Fed, the European Central Bank, it will do things to try to improve things in the short run. Now, what can get pretty complicated about all of this stuff is how these policies change in validity through time. So I started out with this discussion of the European Central Bank with talking about MROs and how they're really important in the overall scheme. But as you can see in this graph, MROs are not nearly as important as they once were. Remember those MROs? These are short-term, one-week loans that the European Central Bank makes to its member banks, and there's just not a lot of those happening right now. In your quiz, I'm going to ask you some questions about this, so we'll try to investigate this a bit more. What I really love, though, about these types of policies is once you understand them, how much of an influence it has on the economy and our everyday lives. And I mean this in all sincerity. Your life would be different if it wasn't for the Fed and their policies that they engage in. And it's not quite as extreme an example because they're in the Eurozone, but even European policies affect our day-to-day lives. Prices of goods and services are obviously affected by the Federal Reserve. Job prospects, how strong the economy is. Federal Reserve is always trying to keep the economy relatively strong. The housing market is very much influenced by Federal Reserve policies. Just as an example for me, I bought my house in 2020. The interest rate on that house was 2.875%. It's really, really low. Nowadays, interest rates are a lot higher than that. And I feel like I really couldn't move, even if I wanted to. If I wanted to take a job elsewhere, the fact that my interest rate is so low and the interest rate on any new house I'd buy is so high keeps me tethered to my current home, literally affecting my day-to-day life. The number one way businesses start is by borrowing money, and interest rates are indirectly determined by the Federal Reserve. Nominal and real exchange rates, which we've learned about in this class already, are obviously affected by the policies made by these central banks. And I could go on and on throughout the list. So if this is the first time you've seen this type of material, first of all, I hope it excites you and I hope you care to learn more. If you're an econ or finance major and this doesn't interest you at all, that's a bad sign because this is the type of thing that you should really, really care about. All right. That's the end of the lecture. As I said before, I've got some other materials for you. The quiz is going to involve content from this and also some outside material. And this is probably the most intensive one that we're going to have during this class. Good luck.